The richest people in America pay zero federal income tax. Not because they're cheating, because they're using rules you've never heard of. And by the end of this video, you'll know all of them. We're breaking down 5 legal strategies billionaires use to keep almost every dollar they earn. The same playbook your CPA probably won't bring up unless you ask. You'll see the loophole that lets them rent their own house tax-free, the move that erases capital gains until they die, and why an offshore trust isn't actually shady. It's just smart. Stay with me, because the wildest one is at the end. Here's the thing nobody tells you. Billionaires don't sell their stocks. Selling is what triggers tax. If you sell $1 million of stock you bought for $10,000, you owe tax on the gain, so they don't sell, they borrow against it. When a billionaire wants cash, they walk into a private bank and pledge their shares as collateral. The bank lends them millions at 1 or 2% interest. Loans aren't income. There's no taxable event. They live off the loan, pay the interest, hold the stock. Then, when they die, their heirs inherit the stock at its current value. It's called a stepped-up basis. The capital gain that built up over 40 years, gone, wiped clean, buy, borrow, die. That's the whole game. Every other strategy in this video plugs into this one. Now stay with me because this next one is the most underused loophole in the entire tax code. Section 280A, the Augusta rule. It lets you rent your personal home for up to 14 days a year and collect that income completely tax-free. It was originally written so homeowners around the Masters golf tournament could cash in without filing, but here's how it actually gets used. A business owner owns the company and the home. The company holds its annual meeting at the owner's house. The company pays the owner a fair market rental rate. Say $5,000 a day, 14 days, $70,000. The company writes it off as a deductible business expense. The owner receives the $70,000 completely tax-free. Same dollar, one pocket to the other. Except now it's tax-free instead of taxed twice. Every consultant, doctor, agency owner with an S-corp can do this. Most don't. Real estate is where the rich quietly print money, and the 1031 exchange is the cheat code. Here's how it works. You sell an investment property and roll the proceeds into another investment property within 180 days. You pay zero capital gains tax on the sale, and you can do this forever. Sell a duplex you bought for $200,000 that's now worth $2 million. Buy an apartment building. Sell that, buy a strip mall. Sell that, buy a hotel. Each time the tax bill is deferred, indefinitely, and then we loop right back to strategy 1. When the owner dies, the heirs inherit at the stepped-up basis. All those deferred gains across 30 years of trades, erased. The IRS never collects a dollar. Real estate dynasties have been doing this for decades. It's not a loophole. It's a feature. Quick check before we keep going. If you've made it this far, you already know more about the tax code than 90% of people. Hit subscribe so the algorithm shows you the next one. Now, the Roth IRA, the holy grail of retirement accounts. You pay tax on the money going in, but every dollar of growth comes out tax-free forever. The catch is, if you earn over about 160 grand single, you're not allowed to contribute. So here's the move. You contribute to a regular non-deductible IRA. There's no income limit on that. The same day, you convert it into a Roth. Conversions don't have an income limit either. You just walked your money through the back door, completely legally. The mega version uses a 401k plan that allows after-tax contributions and in-plan conversions. That lets you stuff up to $70,000 a year into a Roth account that grows tax-free for life. The IRS knows, Congress hasn't closed it, and now the one with the worst reputation, offshore trusts. Most people hear that and think Panama Papers. The reality is much more boring and much more legal. A foreign asset protection trust, usually set up in the Cook Islands, Nevis, or the Caymans, does not help you dodge tax on U.S. income. The IRS still wants their cut. What it does is shield your assets from lawsuits, creditors, and even U.S. court orders. A judge can order you to hand over the money. The Cook Islands trustee will politely refuse. There is nothing the U.S. court can do about it. For someone with $200 million and a dozen lawsuits a year, that's the entire point. Pair it with a holding company in a low-tax jurisdiction, and you can structure foreign-sourced income to be taxed at 5% instead of 37%. Legal. Disclosed. Standard practice in every serious family office. None of this is illegal. None of it is hidden. It's all sitting in the tax code, which Warren Buffett famously said is rigged for people who can afford lawyers. You can use the Augusta rule. You can run a backdoor Roth. The 1031 is right there waiting. The system isn't broken. It's working exactly how it was designed. If this changed how you see taxes, comment assets below and I'll drop the next one. The 5 assets the ultra-wealthy buy that most people never consider. This isn't financial advice. Talk to a CPA before you do anything.